Greetings, everybody. This is Jeff Scott, broadcasting tonight from down under on beautiful Hamilton Island in the Coral Sea, just north of the mainland of Australia, where we had the excitement this week of going on and being able to snorkel on the Great Barrier Reef. I wanted to do a very quick presentation for tonight. I call this Rally to Resistance, and I think they're really at a crossroads. Will we go on to new highs, or will we go back and retest the lows of this midweek? Disclaimer, as always, this is for education purposes only. Anything I recommend is the spirit of education, not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments, and I'm not affiliated with any software vendor or trading company. As always, I have my wall of influences. Since I want to do this quick today, I'm not going to spend much time with them, but a number of websites are there, and just pointing out Ian and Ron. And for those that are at their meeting, I hope you're having a great meeting, and my buddy George Lee. I have lots of different programs. What I need on my desert isle are TradeStation, Thinkorswim, and Genesis. And for analyzing the market after hours, I use HGSI and EdgeRater, and I do seasonality with Magenta, Best Choice, and MarketSmith. As always, I always want to start my presentation by trying to understand where we are in this market. And the question is, have we finished stage 4, and are we going to start another rally up? Or is this just another brief move up before we roll over? And I think if you listen to the talking heads, you hear both stories going on. But let's see what the charts tell us. I did want to remind everybody that I have formally announced the second Florida Summit. I'll be joined by George Lee and hopefully some others to be announced later. It'll be February 7th through 9th, which my dates sometimes are screwy, but it's Saturday, Sunday, and Monday. Tentative location will be the North Palm Beach Best Western Executive Conference Center. I'm still negotiating the room rates. For more information and to hold a seat, hgsidoc@gmail.com. This week ahead, on the left, are some of the key economic releases. Looking at them, CPI is important, as is crude inventories and natural gas and new home sales, and leading indicators, but relatively quiet week. What's not so quiet will be on the right-hand side, where starting Monday before the open with some big players, including Valiant Pharmaceuticals and Halliburton, kicking off pre-market on Monday, and a very big week of earnings announcements. Let's take a look at the market. Again, I'm going to go quickly. This is not as much for teaching as it is just to keep a continuity of what I think the market is going to do. I did not keep my data last week because I was busy with a person meeting and getting ready for Australia, so I don't have the GPA, but we can look at the other usual suspects. There is no Hindenburg. Bucketology shows that we've now moved to 69% below the midline and less than 10% underneath the lower band. If you go back to Monday, you can see we hit 38%, which unfortunately this signal in this sharp sell-off was not as accurate or as meaningful during the rest of this bull market, but we have come off of this severely oversold figure. On the Ian index, what's interesting is the Russell 2000, which is the index that led this market lower, turned green on Thursday. On Friday, all the indexes went to yellow from red, which I would view as a positive. Notice the yellow under bandwidth. That, I guess, is somewhat consistent with the volatility we have. A rising bandwidth would not be good for the market, and we had no kahunas at the end of the week. I'm not going to go much yet into the various EdgeRater signal makers, but I do want to look at seasonality ETFs and point out, let's see if this will have what I'm looking for. IWM. I guess the key thing here is to point out that we're going into a seasonally favorable area, and that's not the one I was looking for. Let's see if I have it over here. So as much as October has been pretty painful to date, we are going into a very favorable part of the year, and this is looking at the spiders with EdgeRater, and shows that over the next month, 14 out of 20 years, the spiders are positive, averaging 2% gain. You can see the Dow, positive 11 out of 16 years, also a 2% gain. So we're now going out of the difficult period of the market and one where we might expect us to see gains going into the end of the year. The question being, when does the nonsense or the volatility that we've been going through end, in the year-end rally and January effect in small, especially in the small caps, begin? And perhaps seeing the strength in the small caps might be, as John Person talked about a week ago, the January effect coming in early. All right. To get a sense of the strength or weakness of the market, I always like to look at the elder indicators, and specifically the impulse. What I'm looking at here is blue means the price is above the moving average, or the MACD is higher or less negative, as the case may be. Green means that the price is above the moving average and the MACD is positive or moving positive. And red would mean the price is below the moving average and the MACD is getting deeper negative. So we see blue, this is the S&P 100. You'll notice a theme being where we had sharp sell-offs, reversal signals on Thursday, and a positive day on Friday in almost all the indexes. But note, in most, the weekly is still negative or red. So let's go into the indexes. Here's the NASDAQ composite. 2 days of blue. This blue dot here is a buy signal on John Person's indicators, but red on the weekly. Notice that we've worked off these MACD divergences, which I talk about so much. On the Dow Industrials, similar pattern, reversal on Thursday, positive day on Friday with a person buy signal, but still red on the weekly. The Russell, certainly the strength in the market right now. Those green dots underneath both the daily and the weekly prices, those stand for MACD convergence or positive divergence. I think from a definition perspective, it's convergence, and that would suggest that the market was oversold and ready for a bounce, and that was because we had a lower low here, but not a lower low on the MACD, suggesting that the bears perhaps are losing a little bit of their power. We have that MACD divergence on the weekly, but it too is red. But you notice the green, and green tells me that it's safe or reasonably safe or a reasonable option perhaps to be looking at small cap stocks, the Russell stocks. The SOX, blue and red, and that's really the theme, which is we had enough of a recovery on Thursday and Friday with that big reversal bar again on Thursday, positive day on Friday, to change the weekly off of red, and we still have the daily off of red, but we still have red on the weekly. Here's the NASDAQ, similar pattern, and lastly the S&P 500. So just to reiterate for those who haven't seen this before, my interpretation of how Alexander Elder uses these colors is he uses them as a filter. When the color of the price bar is green, then he has the option to be buying if he wants to be buying, or he can be holding, but he would not be shorting when the bar is green. When the bar is red, he has the option for shorting or holding, but he would not be going long. And when the bar is blue, he has the option of going long or short. And as I've heard him educated, it is a filter to go long or short. The only way you can get these colors on your trade station or on your favorite charting package is to actually buy his indicators at elder.com, and he's probably the most reasonable priced of all the indicator sets in the market. So just something to consider. When I see the red on the weekly across the board, there's a little danger signal there in my mind, although I have to admit that the blue and the green on the dailies is something that I like seeing. Let's jump into HGSI. I don't know what this dot is from. Who knows? Razor Synapse 2 Configurator. No idea what that is for. Sorry for that thing in the upper left-hand corner. So we're going to open up the warehouse view. And of course, since I just changed my resolution for this video, I'm going to have to resize everything. So in the warehouse view, what I'd like to do is start with the top-down view, looking specifically, and I guess I should probably plug in my computer. Let me do that while I'm sitting here. All right, so I'm going to go to Ron Brown's groups down here, Major Markets Plus, and I'm going to go to top-down view. So this is all price and volume, heavily weighted on yesterday or Friday, some on Monday, or the last 5 days, and actually a little bit towards the last 3 weeks. So the first thing I notice is that we're starting to see some green on accumulation direction and velocity. Force index positive, 2 has turned positive. Some of the percent B and bandwidths have gone green. What's leading is transports, utilities, industrials. What's lagging are the dollar, silver, gold, volatility. Small stocks still bringing up the rear. If we look at 5-day performance, volatility was up 3.5, transports were up 3.2. And over the last 5 days, the Russell has led some of the rally up 2.8%. However, as I said, this is more heavily weighted on the last day, and you could see on the last day the Russell was down on Friday 0.3%, volatility was down over 12. Let's take a look at some of my favorite to get a sense of what the market's doing and sort of outline where I think some of the upside or risk might be in this coming week. This is the S&P 500, so very quickly I want to look down here and see no Phoenixes or Eurekas over the last 5 days. This is a bingo, which is our HGSI sort of very oversold, babies out with the bathwater indicator. Don't see that very often. And my bongos are both red weekly and daily. Now let's go to a cleaner picture and see what we see. This was my target for the downside, and it was sort of the confluence of the 200-day moving average, resistance here, and support over here. As you can see, we broke through that and almost went with this bar here down to my second target, which was the prior low from April. We bounced from there, and now let's clean up my chart and talk about where we might be going from here. So as I look at this, we have a number of challenges. In happiness is taken out prior high, but we have a long way to go to take that high out. And as I would see, my first target is, can I get through this 200-day moving average? And I think that will be something that will be challenged by Monday or Tuesday, because we might see move up to the 200 and a fail. If that's the case, perhaps we go down and we test the prior low. If we can break through that 200, then my goal would be to get back up to that 50-day moving average, where we'll have another test. So a lot will be seen as to whether or not we can get over that 200-day moving average early in the week. And frankly, from my perspective, that's a critical question on the S&P. If I look at the Dow, I see a similar picture with a breaking the prior rising trend line from the August lows. Big bottoming tails here, reversal day on Thursday, and a big up move on Friday. And just like the S&P 500, we have a lot of work to do. We've got to get above that 8, which shouldn't be much of resistance. But really, can we break through that 200-day moving average on the first try? Or will this be something that is a problem and becomes resistance for some period of time? I respect moving averages. And you notice how the 200-day moving average, little porosity there, has been support going up for well over a year. Now, often strong support, and I would say that's very strong support, it turns into be resistance on the way up, so it will be interesting to see. If I look at the NASDAQ, looks exactly the same, the difference being that we've actually moved up closer to that 200-day moving average. So for me, I'm going to be watching these daily charts real time in the market on Monday. That is, if I'm not on an airplane flying to Melbourne, and really base my decisions on how I'm going to judge and play this market based upon how we handle that 200-day moving average. I think there's still a lot of risk that we fail there. That may be why the weekly candles were red, weekly bars on the elder indicators, and I think that's a critical decision that we'll have to see. But a break above the 200, and potentially we run right back up to that 50, which would be a big move on all these indexes. If I look at the Russell, we should see what's had the biggest move off the bottom. Of course, it had the deepest bottom, breaking through what had been support in the past. It's now above the 17, and my next target here is going to be up towards where the 50 is. And for the Russell to get to happy land and take out the prior highs, the Russell's going to have to get through both its 50 and 200-day moving average as well. Looking at the VIX, perhaps the VIX has peaked. Big day on Thursday with the reversal. Friday opened up and sold off and closed at a drop for the day. And obviously for this market to turn around, we're going to need to see the VIX come back into that 14, 16 range where it's been for some time. As actually this was Wednesday, Thursday, Friday, it did have a big sell-off down to here. But it'd be nice to see this continue dropping, and as George Lee likes to say, he makes most of his money on a falling VIX. Rising VIX is bad for stocks, falling VIX is great. The dollar, which I think had been a headwind for stocks, sold off, peaked here about 10 days ago, pulled back pretty hard, had an up day on Friday, but is well off its highs. And if we look over a weekly chart, weekly chart, we can see it ran up into areas of prior highs and has backed off. Continued strength in the dollar would be an additional tailwind, or headwind rather, for stocks. Gold, this is a line that I drew weeks ago. I put this line in here, and gold held support. It's got a lot of overhead supply. It's got the 50 and the 17, a few dollars above it. It's got the 200. But if you're a gold bug, this might be a decent place to be buying gold and setting your stops below the support line at $115. On silver, I'd rather be buying gold. It failed the 50 here and has a lot of work to do. And lastly, oil, which had a deep sell-off. I don't know if I'd call that a turnaround day on Friday, but did close well off the lows. We'll see if that carries into this week. So I guess in summary, I would say the markets have come back some, but as a rule, the markets have some resistance close overhead, and those 200-day moving averages, in my mind, loom quite large. If I drop down and take a look at the industry groups, you see I have 177 industries. 2-day up, just to show you a strength of the market, you can see 80 of the groups were up. If I look at the 2-day down, you could see the only groups down here: steel, banks, department stores, electronics, internet media, specialty apparel, footwear, and precious metals. Now, in this fast market that we're living in, 2 days may be fine, but I've been playing with a 5-day exponential on Force to really find the groups that are moving and not just one-day wonders. But because of the change that really came in last week, I do think the 2-day is more apropos. So let's go to the 2-day up, take a quick look at the top groups. Midstream oil and gas, as long as interest rates stay low, one would expect strength in this group. And as you'll see as I look at the first couple of them, here's Williams Company to start. These are characterized by really big dividends. And let's put in my busy chart. So what I see here is that this has been in an uptrend, pulled back, bounced off the 200, which is what I'd like to see the indexes do. Closed up on balance volume, closed above its moving average. Starting to see some green up here above. It makes money, but most importantly, it pays a 4.3% dividend. Energy Transfer Partners, this chart looks identical. It had some pocket pivots and kahunas. Everything is green up there. Had a mobile breakout, a Bible gap up rather on Friday, a mobile breakout on Thursday. Pays a 2.6% dividend. Kinder Morgan, 4.7 dividend. Charts are all identical here. This is coming out of a squeeze, had some pocket pivots and kahunas. All these stocks had been selling off as interest rates rose, and I think that one of the problems with the MLPs is that if interest rates start to rise, then one, it becomes more expensive for them, like utilities, to raise money, and their dividend rates will become less important as interest rates on other instruments start to rise towards them. So as we've seen throughout the year, MLPs have been strong, especially when the interest rates remain low. Semiconductor devices, this is bouncing back after getting hurt earlier in the week or a week ago, and they were some of the first groups to crack and also some of the first groups to recover. So let's take a look at the first two or three. You can see on Xilinx, this is kind of ugly chart where it's below the 200-day moving average. It had bingos followed by a pocket pivot and a kahuna, and a big gap up on Friday. I don't like stocks below the 200, and unfortunately most of the stocks, or many of them, are below the 200 right now. Micron has been a big leader over the last several years. You can see the big move up here on the weekly chart, the extreme pullback. Micron seems to have reversed off of its 200-day moving average. However, the technicals still look red, and it has diminishing earnings per share growth, so I'm a little bit suspect on this, but this has been a big leader. AVGO is one that has a similar chart pattern to Micron. Nice uptrend, pulled back steep to the 200-day moving average. Bingos here. They came out and reaffirmed and raised earning guidance. And here's Qualcomm. So even though this is a highly rated group, you can see each of the stocks has sold off very hard recently. What's the third group down? Oil exploration. It's a place that you can start to look perhaps for bargain hunting. These have sold off hard, as you'll see, because of the fall in oil. And you can see this is Chesapeake. Had a viable gap up, pocket pivot and kahuna on Thursday, gave up a little bit on Friday, severely oversold. Occidental Petroleum, same chart, sold off with oil, looks like it wants to go again. But these are all stocks that are now in downtrends, at least short term, and each of these, here's Devon Energy, has to get above these moving averages, have tons of overhead supply, and really are subject to what does the price of oil do. And here's EOG Resources. Again, opportunity perhaps for bargain hunting. And some of the ones that were really our favorites on the way up, take a look at, for example, FANG, how deep of a pullback it had, and although it's had a bit of a move, it's still way off its highs. I worry about these stocks because oil, I'm still questioning whether oil is going to stabilize, and each of them have a lot of overhead supply and some big moving averages to get over. Unfortunately, after the market is sold off as hard as it is, we're going to find a lot of stocks that are well below their 200-day moving average. Schlumberger and Halliburton on the oil services, again, these sold off with the fall in the oil prices. They firmed last week and had nice moves on Friday. This is Schlumberger. Had a big gap up, although it closed towards the bottom of its day on the gap up here, but below the 200-day moving average, as is Halliburton, with really almost the identical. Again, at one point, these things have to be considered bargains, as they are way off their high. In the case of Halliburton, for example, from the high to the low, it dropped 35%, and from the close of that day to the close on Friday, it's only had a 4% recovery. So again, these might be interesting, but you've got the 200-day and the 50-day moving average you have to get above, And so they have a little bit of work to do, and you can see bingos came in here as well. This has been a really rough sell-off affecting a lot of different industry groups with lots of bingos on stocks, which we haven't seen in years. Patterson, again, similar pattern. Certainly the leaders are Schlumberger and Halliburton. Next group down, home builders. This is something that I'm interested in. They seem to be showing up on a lot of my screens. Look at their 1 and 5 day performance. Obviously, these have been beaten up, but with the low interest rates and increasing new housing starts, perhaps these are an early indicator that maybe the economy is stronger than we thought. Typical pattern, it's gone sideways for some time. I look at a weekly chart. These had a big run, and they've been going, peaking in June of 2013. The turnaround really occurred about this time in 2011. They've been basing for some time, and this was a big week for housing stocks. Let me see if it'll be a one-week wonder or something to pay attention to. Pocket pivots, kahunas, mobile breakout from a squeeze. Still has to get above that 200-day moving average. The D.H. Horton had a bingo within the last week or so. Lennar, I like this even more because it's broken above its moving average resistance. And on Friday, everything turned green. Mobile breakout from a squeeze, pocket pivot, and a kahuna. And again, if I look at this on a weekly basis, we should see a similar pattern with a big move up, sideways. This is coming off of a base. It's got great earnings per share growth. It trades at a multiple of half of its earnings per share growth. And this is a stock that's going to make it onto my watch list. If I look at KB Home, similar to the first one we looked at, D.H. Horton, where it's below its moving averages, but a nice move up over the last couple of days. Pulte Group, similar, it's got to get above that 50. So to me, my favorite is Lennar, which has already broken above its moving averages, but each of them having similar patterns. Certainly a wolf pack is moving within the home builder industry. Number 6, base metals. Alcoa had sold off pretty hard, as had Century. You can see they had big moves this 5-day and 1-day. Alcoa is the first one out of the chute. They actually came out with great earnings, and the market sold off, and they were taken down with it. They bounced off their 200-day, had a kahuna on Friday. I'd like to see it take out its 50-day moving average, and I might be interested in buying this again. Great earnings per share growth. They had a great earnings report. Constellium, NV, deeper sell-off. I like Alcoa in this group. I just usually look at the top 10 groups and go down the first couple of them. Communications equipment. So you have Apple, down 3% on the week. Let's just take a look at the first couple. Apple's certainly been one of the stocks holding up the best in this market. You can see it's dropped below the 50. Doji on Friday with the kahuna. Be interesting to see. On-balance volume is heading down below the moving average, which would be bothersome. It's in a squeeze. Not that excited by the chart. Here's Cisco Systems. Deep sell-off below the 200. F5 Networks bounced at the 200 after being in an uptrend. A little bit more interesting than the others because it held at the 200. You could set your stop not much below that 200 if you're a big fan of this. And what do we have here? Brocade looks a lot like the last one. Sometimes it's hard to get excited when you see industry group after industry group with most of the stocks below their 200-day moving average, but this was such a tough sell-off, it's not a big surprise. Biotech moved at the end of the week. I have a number of these. Let's take a quick look at the top, say 4 or 5 of them. So this is Regeneron. This is a big daddy from a drug development perspective. Most of their drugs are licensed to others. Big viable gap up on Friday, mobile breakout from a squeeze, kahuna in a pocket pivot. Worth doing some research. Looks to me like it's probably near an all-time high. What a great lower left, upper right on the weekly. I like them a lot. I'd rather buy them on sale, and I don't think they're on sale anymore at their new highs. Gilead is one of my favorites. It sold off hard. All of their concern is based upon concerns about reimbursement for their very expensive hepatitis C product and their new combination pill. I spoke about this a couple weeks ago, and let me just reiterate something. It is against the law today for Congress to negotiate prices on drugs with drug companies. As a physician, I will prescribe what is best for my patients. Although I'm concerned about the cost of drugs, I am not going to use J&J's drug, which is less effective because it's cheaper, when I have a more effective drug. So lots of smokescreen about Gilead and the cost of their drug and whether or not payers will pay for it. To knock this drug off, it's going to have to be replaced by a drug that's equally effective and cheaper, or something's going to have to change, or a better drug. And to affect price on a bigger scale, Congress is going to have to change the law. So I'm a big bull on Gilead until either a better drug comes out for hepatitis C, which I don't know of one today, or Congress changes the law and allows Medicare to negotiate drug prices. Amgen pulled back after a great run-up, had a nice day on Friday, could not stay above the 50. And so I worry on these stocks, including Gilead, about whether this 50-day moving average is going to turn what was support on the way up, will turn into significant resistance. Intercept, this is sort of your lottery ticket. It's an expensive lottery ticket. They have an interesting drug for a disease of the liver called NASH, one which I never knew existed until I read their initial papers. Very exciting product for patients who have cirrhosis that are not related to hepatitis or viral hepatitis. You can see a couple of pocket pivots late in the week, but it's an expensive stock that will be totally news-driven for years. And then Celgene, which is one of my favorite on the biotech space, also sold off hard, did not quite go down to the 200. It's got to get above the 50 before I think it's interesting again. But biotech definitely moving back up the rankings. The next group is refiners. Take a look at these real quickly. I think there's some mixed bags in here, frankly. Phillips 66 is a refiner. You could see the deep sell-off they had with bingos galore. On-balance volume with a hard sell-off as well. Dividend yield 2.8%. Why is it up there? Top of the list because it was up $2.5 or 3.5% on Friday on 8 million shares. EMES, one of the fracking companies, great earnings per share growth, pays a 5% dividend, had a sell-off from 144 down to, a little bit over, about 50%, had a big move up this week, and that might be another one for me to put on my watch list. If I believe fracking is here to stay, then this is a company that I think has gotten punished a little bit more perhaps than necessary, and I'm buying it right off the 200-day so I could set my stop not far below it. Valero's another refiner, similar to Phillips 66. Decent last couple of days. It pays a 2.4% dividend. And then we have Marathon, again another refiner. So of the group, the EMES looks the most attractive. The refiners you're probably buying not because of their chart pattern, but because of the switch to winter oil, the improvement in their margins at this time of the year, and the fact that they pay a dividend. Lastly, infrastructure. We'll go down the first five. This has been a group that's really been strong. Microsoft had been strong, sold off. Hard for me to get too excited with their lack of significant earnings per share growth. Pays a 2.6% dividend yield. FireEye, I'm not even going to comment. It's flatline, well below the 200-day moving average. Splunk, up 3.36% on 2.8 million shares. I don't like that 200-day moving average right above it. ServiceNow, more interesting. Don't like its earnings per share growth, but it did break above the 200. The PSI reversal mobile breakout from a squeeze. And a Kahuna, I'll probably look deeper into that one. And here's been a great stock, PANW, sitting right about $100 a share. It's had a huge run up. Don't like the earnings per share growth, but the story here in their product line are supposedly extremely good. And with all the companies having their technology hacked into, there's a lot of opportunity for PANW and other companies like it. On the downside, let's just go back to the 07 groups. On the downside, just take a look at a couple of these. Take a look at the gold stocks. Despite the fact that gold seems to be bottomed, these stocks had another tough week. This is American Barrick, our Gold Core. It's probably way too late to short these stocks. Here's AEM. Hard to see why anybody wants to be buying these, as they're all in continuous significant downtrends. Footwear, I'm just curious, has been a big leader over the last 6 months. The only one performing worse than the index, or I guess better than the index from the bear perspective, is Ralph Lauren, and you can see it's struggling now to get above its 200-day moving average. That is a potential short. If this market sells off and Ralph Lauren can't get above that 200, that might be an opportunity to make some money on a market sell-off. Obviously, there's a lot of value in the name, but it trades at a multiple of 19, pays a dividend of 1.2%. It's growing at less than 10% per year, in fact negative. This is a vulnerable looking stock if the market sells off from here, and you can certainly know that you trade above the 200-day moving average. You don't want to be short this stock. Deckers, let's just look at Deckers and Michael Kors. Looks like a lot of the stocks on the good list pulled down to the 200. Had a bad day on Friday, down almost 3% on 682,000 shares. And Michael Kors. This has been one great to short when it gets close to the 50-day moving average. So looked at some of the top groups. Again, this is a market that is at a crossroads. A big day on Monday could get us above the 200-day moving average on all the major indices, and then we have to just wonder about how can we get up to that 50. Seasonality, the wind is at our back. We've got a mid-year election coming up, increasing seats to the Republicans. Could be viewed as a positive by those on Wall Street. We also had, let's just go back to the S&P and the NASDAQ so I can make a couple comments about things that we've learned from Ian over the last couple of years. Actually, I want it to be there, my bad. Let's go into that S&P 500, which is probably right in front of my face. Here it is. And let's take off all the junk. My indicators, not really junk. Let's clean it off. As we've talked about on many occasions, since, well, this is May of 12, here's March of 09, we've had just a huge run up. We've tested the 200-day on multiple times and ultimately bounced. The most similar correction to what we're dealing with now occurred in 2011 at the time that QE2 was being withdrawn from the market, so a lot of similarities there. If I look at the extent of the pullback from the high to the low, it was 9.8%. So on the S&P 500, we pretty much got the long-awaited 10% pullback. So a break above the 50, I'm going to turn very bullish considering where we are during the year. Excuse me, a break above the 200. But I still want to see us get above the 200 because we've now had our 10% correction. And on the NASDAQ, right in front of my face, you know that, it's the hardest thing to see. Put a double top there. The NASDAQ gave us a correction of a little bit over 10%, and the Russell 2000 from the most recent peak was down 13.8%, but in reality the peak is back up here and we're down 14% from peak to trough. So that's actually perhaps mixed news. It's good news to me because all the naysayers have been expecting this big pullback. They got it. That's the good news. The bad news is we still got to get above major resistance of that 200-day moving average for me to be a big believer. But at this point, you got to play the market we get. The last 2 days were extremely bullish. Let's see how Monday is. I hope you all have a great week. Once again, I just wanted to remind you that the summit number 2 is a done deal. Probably about 40 people. I've had about 15 of you already RSVP. Email me for more information. I am in Australia for another 2 weeks, 2.5 weeks. So not much will get done as far as sending me checks. But if you want to hold your spot, please reach out to me and let me know. Everybody have a great week. Those of you in PV, I'm so jealous. But then again, I was diving the Great Barrier Reef yesterday, so I can't complain too much. You all have a great week. Bye now.